I think it's happening for reasons that are separate from monetary policy. Short-term interest rates have come down. We've seen that 100 basis points of cuts this year, but other things are happening that are pushing up longer-term yields. I think a big driver of that has been the strength of the U.S. economy. GDP growth has exceeded expectations for this year. I feel the labor market has done very well, so our economy is doing well, and that has pushed up longer-term yields along with other factors. So, mortgage rates tend to be tied to longer-term interest rates, like the 10-year Treasury yield. So I think that's what's driving it. I do expect that over time, as interest rates get back to normal eventually, that we'll see mortgage rates come down. But that's not a forecast of any particular time.
Is it a reason of concern to you? Is it a cause of concern to you that rates are higher while you have been reducing the short-term rate?
Well, we have to take into account all of financial conditions when we think about the transmission of monetary policy to the economy. And I always think about it as how are financial conditions affecting maximum employment or employment and inflation. So it's not just what's happening with long-term rates, which is obviously very important, but it's also what's happening with equity prices, real estate prices, and more generally in financial conditions. So it's really looking at the whole constellation of financial conditions of how they're affecting the economy. So I think, yes, longer-term rates have been one of the factors tightening financial conditions, but of course we've seen a big run up in equity prices that's offset that.